Welcome to MarketTamer.com. You're looking at a chart of the bank index, and today we're going to discuss more the fundamentals behind the banking industry rather than looking at the chart itself. Even though when we're looking at these charts, it's easy to get distracted by day-to-day movements and forget the underlying fundamentals, but they are critical to understanding the long-term trend that's likely to take place. So specifically, we'll talk about mark-to-market and mark-to-model. And if we consider as an example the Worldwide Plaza building from about 4 or 5 months ago when it was sold, it was marked down significantly, something like a $400 million loss from where it had been purchased a few years before. Now, what does that mean? Well, think about it from the bank's perspective. When the initial loan was made, maybe a loan-to-value ratio of 75–80% was used. Now, if the values start to drop significantly, what we find is loan-to-value ratios easily jump above 100%. And obviously, from the perspective of the borrower, there's virtually no incentive to continue paying a mortgage once you know that the loan amount outstanding far exceeds the value of the property underlying. So with that said, what we find is often there is an incentive to sell a property. And the problem for the banks is that they then have to mark to market. And so you see them taking losses on the loans, which are essentially their assets. If that's the case, and if that starts to happen industry-wide, we find that the banks, which already have pretty low capital reserve pretty low capital reserves. The capital reserve requirements are also quite low, but their capital reserves start to become depleted. If that's the case, then it's very easy for the equity of the banks to get quickly wiped out. And as a result, what we find is Sheila Bair and the FDIC have made changes such that banks are no longer necessarily incentivized to mark to market. They're now incentivized to mark to management model. And what that means is they can use things like 10-year average cap rates, whereby they build out a model and they mark the value of the property to the model rather than the market. And the argument is that the current market sales are essentially too low. They don't represent the true value of the property because of the distressed situation of the market and maybe potential difficulty in accessing liquidity and so forth. That being said, the essential values that the banks hold on these loans is not representative of true reality, but representative of what the estimate in the future that the management expects the values to be. And essentially the reasoning behind this is that not only will the banks suffer in the event of large distributions of properties, but the FDIC will then have to come in and save the banks. And ultimately, the structural flaw in the system is that the FDIC does not have the capital in reserves to save the banks should they also go under. Now, on a small level, we see this with smaller banks all around the country. There are dozens and dozens of banks being closed on a regular basis, almost a weekly basis. You'll see in the order of single to tens of banks being closed. And should the mark-to-market versus mark-to-management models be in place, you'll find that many more banks will go under. That's why obviously the incentive is to stick with mark-to-management model versus mark-to-market. The bottom line of all this, if you're trying to think of what's the takeaway here, the takeaway is really to recognize that many of the banks outstanding right now are essentially zombie banks. If true reality set in, if prices represented market prices, the banks would be in tremendous difficulty. And so a game of chicken is really being played right now, and we'll see for how long. Regulatory changes can certainly extend the price levels that we're seeing, and maybe they will continue. But underlying there is tremendous structural weakness, and it's worth being very cognizant of that. So with that, if you have any questions, join us at MarketTamer.com.